market and an introduction of our presenter. After the presentation, which should last about 30 minutes, we will open the floor for questions. Please feel free to send us any questions that arise during the course of the webinar via your chat box. We will get to as many as we can within our allotted time. For those of you not familiar with Axial Market, we are a network of over 9,000 accredited and active steel professionals. We help connect all types of private market participants from live and relevant transactions. Examples of our members include investment banks, SBICs, private equity firms, lenders, corporate development offices, and high net worth individuals. Our goal is to facilitate new relationship building, more easily manage existing relationships, and ultimately close more deals faster. The marketing organization here at Axial Market focuses on providing relevant and informative content to investment and deal professionals in the private capital market space. We do this through hosting events, webinars such as this, and regularly publishing reports and articles on our blog. We are looking forward to a very robust pipeline of events in 2013. For today's webinar on the ABCs of SBICs, we are happy to have Axial Market member Joe Burkhart of Saratoga Investment Corporation. With that, I will turn the floor over to Joe, and as mentioned before, please feel free to send your questions to us throughout the presentation.
Thanks, Joanna. I'm hoping everyone can see my screen. Joanna, is it showing up?
Yep, it's showing, Joe.
Great. Thanks so much. Hello, everybody. My name is Joe Burkhart with Saratoga Investment Corp. I want to thank Axial, Kristen, Joanna, and the others we work with there for the opportunity to speak with you this afternoon. This presentation will be made available both on their website and on my LinkedIn profile. So if you want to access it later or need to take information down, know that you'll be able to find it in the future. With that, I wanted to start by giving a little background on Saratoga. We are both a publicly traded business development company and an SBIC, which allows us to play up and down the capital structure, providing both senior secured debt all the way down to mezzanine capital. We typically make $3 to $15 million investments in everything from buyouts to refinancing to dividend recaps. A little background on myself: I've spent about 12 years in the space and got my start at Ally Capital, which was actually the third SBIC license holder in the country. As Kristen mentioned, this is intended to be a very interactive conversation, and any questions, please feel free to email them in. I did have one restriction: under no circumstances will I take any questions from Manti Te'o's girlfriend. So I need to inject a little humor in this. It's been a long 2 weeks for us Notre Dame fans. So with that, let's get started. I wanted to provide a real basic overview of the program, and my hope was to make this presentation applicable to a variety of different audiences. Everyone from those funds that are thinking of getting an SBIC license to those companies that require the growth capital that SBICs can't provide. Real briefly, SBIC stands for Small Business Investment Company. It's a program that is administered by the Small Business Administration, and it's been around for quite some time, since 1958. The real mission, which has remained pretty constant throughout the history of the program, is to provide capital to smaller businesses to help them grow. At the end of the day, SBICs really have fulfilled that charter, and we can show some of that data a little further along in the presentation. We do operate as a public-private partnership, meaning that the government does not directly invest in any companies. They actually provide us with capital, and we can talk about the specifics of that capital later in the presentation, whereby the managers, companies like Saratoga, make the investment decisions. We make loans and equity investments into qualifying small businesses, and we are both licensed and subject to the regulation of both the SBA and, in Saratoga's case, because we're public, the SEC. So it is a regulated program. Real quickly, it's breaking down the basics of how the capital flows work with an SBIC. the SBA and private investors provide pooled capital to an SBIC, whereby $1 of private capital is leveraged by $2 of low-cost government-guaranteed debt. The program itself has provided over $60 billion of what we would call patient capital over the history of the program to over 100,000 small businesses across the country. SBICs have long been misunderstood. The LP community is taking a very, I think, new and refreshed look at the asset class. Recently, there was an article in Pension and Investments in November. For the first time, I've read in popular press where the rigors of the SBA's due diligence program really have shown a correlation to better returns. So as a passionate member of the community, we're hoping more of these facts and articles make their way out to the press, because it really is, in my belief, a really good program. Real quickly, there are some restrictions on what SBICs can and cannot invest in, and I'll go through a couple of those really quickly. A point that I just had on the last slide is that really it is up to the fund manager, companies like Saratoga, to make the investment decisions. We're able to provide small businesses with loans, debt, equity, practically any type of security class as an investment structure. We are required to invest in small businesses that have the majority of their operations located in the United States or our territories. And we really do invest in a real broad variety of sectors, so everything from manufacturing to consumer goods. The program, because it is a levered program, meaning that we pay an interest rate on the money that the government lends us, really then does have the SBICs gravitate towards particular industries that are able to pay a coupon. Most SBICs tend to have a debt or interest rate associated with them. There are some restrictions on types of companies that we cannot invest in. 2 financial tests. SBICs have to invest in companies with no more than $6 million in net income, and that's an after-interest service and depreciation service. So we talk in EBITDA a lot, so you can imagine, this is companies with less than probably about $15 million in EBITDA. We also have to invest in companies with less than $18 million in tangible book value. So truly, and there's some very specific rules around what is tangible and what is not, which we won't get into now. We also have a 30% restriction that for concentration purposes. We cannot invest more than 30% of our capital in any one business. At least 49% of the employees must be located in the United States. We cannot invest in passive forms of asset classes like real estate, pool finance products, and those sorts of things. Really, the program is meant to invest in and support small operating companies in the United States. And finally, we are restricted to controlling or investing in a business for no more than 7 years, and that really is more of a control test without SBA approval. So those are the rules of the road. I wanted to point out some highlights of the program just to show everyone really how far the SBA and the SBIC program has come along. I'd say over the last couple of years, under the current leadership, guys like Sean Green really have done an incredible job with the program. It's as robust, I think, as it's ever been. In 2012, SBICs provided over $3 billion of financing to over 1,000 businesses across the country. Big increases from 2010 and obviously from 2011. We, as SBIC members, are proud of the jobs that this creates and supports. The 65,000 job numbers is a calculation that the SBA uses, and I'll show a chart later, really supporting a giant amount of companies across the country. More leverage commitments came out of the SBA. We'll go through the data a little bit later. Currently, there's about 300 of us funds operating, most of which are private capital funds. Most do not have the BDC structure that Saratoga has, which we find advantageous, but the SBICs can come in many forms, most of which are these private funds with private LPs and obviously a general partner. Last year, there were 30 new licenses granted, which will show approximately $1 billion in private capital. One thing that makes us very excited about the program and those that access this capital is this historically low interest rate the government is charging us. And we'll go through some of that data a little bit later. And most importantly, in my opinion, is that the SBIC program has historically operated at zero cost to the taxpayers. This is actually a money-making endeavor that the government has, which makes me feel pretty good. So moving on, I was able to take some data that the SBA has put together and publicized in their 2012 annual report, which gives an overview of how far the program has come. And I wanted to go through a couple of these charts. And again, all this information is publicly available, and you can find it on the SBA's website. This first slide shows really the tremendous popularity of the debenture program, which is really the only program that is issuing new licenses today. There was a historical program called the Participating Securities Program, which has become more inactive over the last 5 years. These are all legacy funds. The Participating Securities Program was more of a venture capital program, and I don't believe the SBA has any interest in reviving that program. Really, their focus is going to be on the debenture program. So when I say debenture program, this is going back to the point where the government is lending us money, pooling our money with private capital or our BDC's capital, and then making direct investments in small business. So a really nice growth pattern you can see. This second slide really shows that for the most part, many of the financing structures used involve both debt and loans. So I would say over 4/5 of the money comes in that form. There are SBICs that operate more like private equity funds than finance companies like Saratoga. And in that case, you will often see a structure where they are able to generate some current yield on their portfolio in order to pay the interest rate associated with the SBA leverage. In finance, we all know that matching of assets and liabilities is important. So if your liabilities have an interest rate associated with a current interest rate associated with them, your assets need to produce some current yield to cover that financing cost. Also, another kind of look at the data breakdown of SBIC fund strategies by investment type. The vast majority of licensed funds over the past few years have been mezzanine, and we'll talk about what that is a little bit later, and other credit strategies really making up the lion's share. There are a couple venture funds out there. These are more venture lending funds, so they're not doing pure venture capital. These are companies that have enough staying power. And then, as I mentioned before, about 17% of the funds licensed over the past 2 years really have been focused on buyouts or hybrid, which means structured equity. The program is national. We are all over the place, and there are concentrations of SBICs in major metropolitan centers. Saratoga is based in New York. There are a number of SBICs in the Northeast, Mid-Atlantic, and throughout the country, and they are making investments all across the country. We often find ourselves riding in airplanes, finding businesses in the most remote areas, and meeting a lot of good people across the country. As I mentioned, the uses of proceeds of our financing are used in a real myriad of industries, everything from manufacturing, consumer products, medical, healthcare, services. Most SBICs, because of this kind of current component of return that they require to cover the SBA's debt, tend to gravitate away from industries that may not produce current cash flow. So you're not going to see a lot of SBICs doing real venture or real early stage technology. Companies that have negative free cash flow tend not to make great investment targets for an SBIC. But again, you'll find us most of us will say we're generalists in that we we'll look at a variety of different industries. This is that jobs chart I mentioned to you before. I think it correlates well to the amount of capital that's been deployed. If you have further questions on this, I'd have to turn you over to the SBA. I'm not exactly sure how they're making these employment calculations, but it makes us all feel good. So I thought I'd share this as well. But not an insignificant amount of capital deployed throughout a large number of companies supporting a large number of jobs. This is one of my favorite charts, and one of the reasons you'll find many SBIC fund managers that are in a good mood these days. Historically, the SBA trust certificate rate has mirrored the U.S. Treasury rate. There is a small charge that the SBA passes through, slightly under 1%. So as you can see, SBIC for 2/3 of its money is paying a rate, very competitive rate, sub 3.5%. So we're able to match that low cost of capital with capital that is more expensive, limited partner capital, or in Saratoga's case, BDC capital, with a nice blended rate of return, or a nice blended weighted average cost of capital, and deploy that. And this is why the program has become extremely popular. This low rate environment has made SBICs a particularly attractive financing vehicle. Just to get a little more detail on this, the government holds an auction twice a year, which sets this cost of borrowing. As you see in September of 2012, this last auction was held. There will be another one this coming March, and the rate tends to mirror the 10-year Treasury. Another favorite chart when talking about the SBIC program is the benefit that leverage can create on our returns for our limited partners. This chart at first has a couple things going on, so let me just describe first the axis, the X and Y axis, and then we can talk about what it really means. On the bottom axis, the X-axis, you see the unlevered IRR. So these are the returns that the SBIC's investments are generating. On the other axis, the Y-axis, you see the net IRR to the LPs, to the private investors, the non-government investors. And assuming this low rate of interest rate on our leverage, this break-even rate of 5.7%, the government, the SBA's leverage then becomes accretive to our LPs. Real simply, if you're an SBIC that is generating returns in excess of 5.7%, the LPs are benefiting from this very low cost of leverage. This 10-year locked-in cost of leverage, I should mention. This is a fixed rate, so it does not float, assuming as rates change in the future. So really it can have a very, very positive impact on the rates of return that our LPs are seeing. Also counter to that, on the left-hand side of the chart, you'll see a negative impact. If you're not able to hit that hurdle, well, that SBA leverage gobbles up a lot of that return, and it actually hurts your return. But net-net, I think it can be very beneficial, especially with that very low break point of 5.7%. A little bit on the current state of the applications for the program. There are historically large numbers of applications. This is more reflective of accepted applications. You'll often go through an interview process as you're considering filing an application, where an SBA analyst will guide you to the likelihood that you will receive a license, you will receive your green light, and then your license. I won't go into a ton of the detail, and feel free to follow up with me directly about the different breakpoints the SBA thinks about. There are no hard and fast rules when it comes to how big does my fund need to be in order to qualify for an SBIC license. There is, though, this number, $17 million of private capital that the SBA believes, and the numbers back it up, firms and funds that are able to raise that amount of capital, the performance of those funds have been far superior to funds that come to them on the much smaller side. If you bring $5 million of private capital, most likely you are not going to receive a license. They really are looking for, more than $15, $17 million in private capital. As you can see, there are a number of first-time applicants, but then subsequent applicants. Many funds, and there are some restrictions to how much SBA leverage you can have, but it's not uncommon for a firm to receive not only one but two or three SBIC licenses over the history of the firm. So those were applications, and now let's look at the number of new licenses issued. Last year was a historic amount of 30. Many of these were follow-on, so these were existing participants in the SBIC program, although many new firms. Saratoga was awarded its first license back in March of 2012. So we are part of that class. You'll also see a designation, non-levered and debenture. Real simply, there is an option as an SBIC not to use the government leverage. And folks wonder, well, why would someone do that? Part of when you are an SBA, you qualify you are a qualified CRA, a Community Reinvestment Act eligible investment vehicle. So many banks that are required to follow the CRA rules will make allocations to SBICs. And in cases where you choose not to take leverage, I'm assuming those three are probably either buyout funds or doing more venture lending. But I'm not certain, but I would assume that is the case. So that's my kind of quick overview of the SBIC program. I'm very happy to answer any particular questions. I'm not an attorney, I'm an investment professional, so I don't have a firm grasp on all of the intricacies of the legal side of the program, more on the finance side. And I wanted to spend a little bit more time now for the other part of the audience, those that are joining that would be interested in seeking financing from a vehicle like an SBIC, and what sorts of things to think about as you approach firms like Saratoga. Mezzanine financing is, as its name sounds, mezzanine exists between 2 points. It often resides between the senior debt in a capital structure and the common equity. It plays this kind of hybrid role that sometimes feels like equity and sometimes feels like debt. Mezzanine can be structured in a number of ways. It's often subordinated debt. It can sometimes be what's called stretch senior, where a mezzanine provider is providing a one-stop unitranche facility where they're able to lend beyond what a traditional commercial bank would be willing to do. It is almost always, when it is not playing that role, behind some senior debt, so a subordinated piece of junior capital is a typical structure. Some other common features, junior capital, mezz, subdebt is generally or often unsecured obligations that many times do not require a personal guarantee of the business owner, which makes it more attractive in some cases. Also, our cost of capital and the capital we provide have a higher yield associated with it than a senior piece of paper. We tend to charge double-digit interest rates. And what is the rate? Well, it really depends risk return. If we are investing in a business that we deem to have more risk, well, our structure and our pricing will be commensurate with that risk. You tend to see pricing in the mid-teens. There are a couple different components of how a mezzanine fund and SBIC structures this piece of paper, this investment. Often there is a current coupon associated with the investment, meaning there's a current interest rate that the company pays on a quarterly basis. Another way, another tool in our toolbox from a structuring standpoint is paid in kind interest, which is non-cash interest, always something that in lieu of a cash payment, basically the company will issue another note, a note to the lender in this case, and then when the debt comes due or at the issuer's decision, they often can pay that currently or pay that when the note comes due. And the third lever is equity. Many times a mezzanine investment will have a small equity component. Oftentimes this is structured as a warrant, which is very similar to an option where there is an exercise price, and for that the investor is able to buy below value shares in a business as it grows. Oftentimes we will invest directly in the equity. Saratoga at least tends to put at least 80 to 90% of our investment in the form of a debt security, and then 10 to 20% as a purchase of equity or warrants. One of the real nice features people will talk about with Mezz and with unitranche and with some of these junior debt capital structures is very limited fixed principal amortization. So unlike a senior lender who will often require periodic principal payments, many times Mezz lenders rely on things like free cash flow sweeps, amortization at the election of the company. There's many different ways to structure this, but much less, you'll see far fewer kind of fixed principal amort structures in this asset class. And then finally, this is a debt security. So oftentimes if a company is seeking growth financing or acquisition financing, this can be far less dilutive than raising common equity. It is debt, and for that preference, the cost of it is less than equity. So just a graphic illustration of where mezzanine resides. I took this from another piece, but I would think that senior debt on top, but the senior debt between the senior debt and the common equity, preferred equity, subordinated debt. There's a lot of names for what mezzanine is, but it resides right in that middle piece of the capital structure sandwich. I also wanted to take just a couple minutes and talk about common uses of SBIC mezzanine financing. There's 1,000,005 different transaction types out there, but these were a couple typical forms that I thought of. One case that we encounter, and actually two deals we closed in December had this flavor, where a minority shareholder is seeking liquidity, and in the situation as this graphic illustrates on the left, you can see there's an inactive shareholder. In this case, he owns 60%, he or she owns 60% of the business. The active management owns 40%. In order to buy out this inactive shareholder, in this case, as that middle column illustrates, this business chose to raise 3.5 turns of capital. When I say turns, that's on EBITDA, so that's one of the ways we think about leverage in this business. And for that, the use of proceeds is to buy out the selling shareholder. Those shares are retired in the treasury, and then the management team, in this case, will own 85%. As you see the way this deal was structured on the far right, it's a mezz piece with, there's no rate on this, but obviously a rate, let's say 10 and 2%, 10 current, 2% PIK, and then 15% ownership. Very common way. And then there is usually an agreement, always an agreement, between the senior debt and the mezzanine capital of how that kind of debt works together. So if there is a company that begins to struggle, oftentimes there are covenants that will allow the senior lender to shut off cash flow to the mezzanine lender and really protect its position, and that's really why mezz debt is more expensive than senior debt. A couple other common uses. Acquisition financing. We tend to look at a lot of businesses that are looking to acquire competitors. We often support private equity funds that are doing add-on investments within their portfolio. Growth capital is another very common reason that companies will utilize mezz financing. Everything from building a sales force to building a factory, anything you can think about in and around growth, sometimes even to support working capital. If you can't get a senior lender comfortable with that, the asset side of the working capital, oftentimes they will look at a mezzanine provider like Saratoga. One transaction type we saw a great deal of last year because of the capital gain rate increases that we've seen in 2013 is this concept of a dividend recap, where a business will bring on debt and the use of proceeds will be to pay a dividend to an owner. It's also become an extremely popular transactions for private equity firms to pursue. People oftentimes will say, gosh, my business is performing really, really well, but the valuation multiples that are in the market today aren't the ones I am comfortable with. I think they can be better in the future, or I think this company has the ability to grow. Well, by utilizing a dividend recap, you can have kind of the best of both worlds. You maintain ownership of the business, and yet you're able to pay a current return to the owners of the business. One case in point this year, we closed a transaction second quarter of 2012. By the fourth quarter of 2012, the private equity sponsor came to us. The business was performing very nicely, and they said, hey, we want to do a dividend recap. And there's no better investment partner than companies that are already in your portfolio. So it was a nice way to provide more capital to the business, and the sponsor was able to monetize part of their investment already in a very short amount of time. A couple things to consider when seeking mezz financing. This is very important. We see a number of deals a month. We all have goals for how many deals we try and look at every month. Some things from Saratoga's standpoint, from my standpoint, that make it difficult for a business to support this kind of patient mezzanine capital. High customer concentration. I should say that when we are looking and making an investment decision, debt guys, credit guys tend to think in catastrophic event terms. So if you have only a handful of customers, wow, bad things can happen if that one customer goes away, and what's that business going to be worth when revenue's cut in half? I mean, all those sorts of bad things make mezz investors nervous. Capital intense businesses. We often at Saratoga talk about high return on net asset businesses, service companies, companies with lighter balance sheets that don't necessarily need to consume a lot of capital as they grow. So you're not going to see mezz investors typically investing in real heavy industry, big industrial factories and things that tend to need to spend a great deal of money on maintenance CapEx. Also, those sorts of businesses, those asset heavy businesses, tend to be pretty financeable with traditional commercial bank financing. Asset-based lenders tend to really get comfortable with the value of that collateral. Lack of management. That's a difficult thing for mezz investors to get comfortable with, because at the end of the day, we are not acting as control buyers. We are not acting as private equity buyers where we are very, very, very involved in the management of a business. So the concept of backing really good management teams is something that's always been at the core of a mezz investor's investment thesis. Commodity-like products or services. You won't see low gross margin businesses being very attractive to this. Really, you need to find businesses that have a real special niche, defensible market structure, a lot of different reasons to make us convinced that there is going to be stability in future cash flow, which enables our debt to be serviced. Cyclicality, seasonality, all those sorts of things that create volatile cash flow swings will make it difficult. You won't see mezz investors, for example, investing a lot of money in a retailer necessarily that has most of their money made in the fourth quarter. It's difficult to do with the extent to which we're lending. It's a dangerous spot to be on the balance sheet. And then finally, a rule of thumb I often tell people is that most mezz investors like to see at least 35, 40% equity value beneath our last dollar of debt. And oftentimes that's why you see a lot of private equity firms and mezz firms teaming up together, because let's say a deal doesn't work out as everyone predicted. It's nice to know that there is an institutional pocket of money behind the company being supportive, doing the right things, and helping to right the ship if things go wrong. Lastly, I wanted to share my LinkedIn profile, and then just where I've posted a bunch of information I've collected over the years about mezzanine financing and ways to approach mezz lenders, and and the SBA, if you're interested in receiving a license. The annual report that's on their website is really, really good. It has a lot of great data. Sean Green and his team have done a tremendous job really making the SBA a world-class organization. There's also a really good piece put out by an accounting firm in Baltimore, SRR, talking about the benefits of mezzanine financing that's written more to a business owner, which I'd encourage you to check out. And then our website also has some good information available. I should give my website address. It's saratogainvestmentcorp.com. Also, I'd offer, if you ever have questions, I'm happy to talk through a transaction. At Saratoga, we're a flat organization. We often give very prompt feedback on what sort of leverage we think would be appropriate for our situation, and I'm always happy to do that. So my contact information can be found there. So with that, I'll turn it back to Kristen and answer any questions people may have.
Thank you, Joe, for that very clear and insightful presentation. We have a few questions from our audience that I will ask you now. Our first question is, can traditional private equity firms who structure their deals as a form of current pay raise an SBIC, or is this limited to only traditional mezzanine firms?
No, they absolutely can. I know a number of them. One that's coming to mind is a group called Levine Leichman, which is a private equity, middle market private equity firm, good firm out of the West Coast. They have an office in New York as well. How they do it is they tend to structure a one-stop kind of junior capital piece where they'll obviously put the equity in. They're a private equity investor. They're owning the balance, they're owning the business, but then also structure a piece of sub-debt above that, which enables them to take current yield out of the deal, which they then can use to service the transaction, to service the SBA's debt. When the SBA is considering you for a license, they want to look at a couple things. Track record of the team. How long has this team operated together? What has the performance been? And then, spending more time on the strategy. But I think that's the order that they look at it in. It's, really, okay, is this a backable team that we want to be in business with? And then, okay, how are you going to pay us back? How are you going to structure things where your levered fund is going to make sense for not only your LPs, but the government itself?
Thank you. Our next question is, are you capped on the percent equity you can take as an SBIC? Said another way, does the sponsor need to maintain 51%?
No, an SBIC can own up to 100% of a business. Really it has more to do with, what will make the deal happen. Most cases, a management team will own a percentage of the business if there are any co-investors. But at the end of the day, your capital can be used to do buyouts. Saratoga tends not to do that today. We're really focused on being a financing company, a provider of financing. But you can do a traditional buyout out of an SBIC. There's a number of firms that do just that. Our friends down in Philadelphia at Boathouse Capital, for example, are more focused on doing buyouts than lending.
Our next question is, at Saratoga, how many mezzanine deals as a percentage have gone bad?
Well, I'm happy to say that we've recently received our license, so going back to March, so no deals have had any issue. I'm knocking on wood now. The quick story on Saratoga I should mention as well is that we acquired a orphaned publicly traded BDC about 2 years ago, recapitalized it, and did a lot of the right things. So our portfolio is still relatively new, and performance to date has been great. We last year invested about $75 million across 14 different portfolio companies, which we're pleased with that production amount, hoping to do even more in 2013. We also issued over 50 term sheets, so we've been very active in the market. There's a lot of reasons why you may not close a deal after you issue a term sheet. We take pride in delivering on the terms we offer. Oftentimes a sponsor may lose the transaction and not win the auction, or traditional senior lender will step up and provide more leverage than they initially indicated, so not really making room for a piece of mezzanine, but we've, so far so good.
Our next question surrounds compliance with the SBA. The question is, please describe the reporting requirements required by the SBA for SBICs and the costs associated with satisfying such requirements.
It's a great question. We are regulated. We actually had our first examination a couple months ago, where they send an SBA examiner in. I spend a couple days looking through countless amounts of data, our investment memorandums, process and procedure for boarding loans, and it's it happens on a very regular basis. The cost to doing that is an interesting question. At Saratoga, we choose to outsource a lot of the backbone to a firm that is in the business of supporting, it's PEF Fund Services, probably about 150 different SBICs across the country. So when we close a deal, we have process and procedure of how we board the loan, how we maintain compliance throughout it. So it is not without cost. I think if you look at the trade-offs, there is a good story to be made that you can do this by using a number of the different consulting firms around. If I had to guess, I would say a couple $100,000 a year.
Does the SBA publish a listing of SBIC licensees by geographic or industry focus?
I believe they do. I should also point out the industry group is called the SBIA, the Small Business Investors Alliance, and they've got a great website with a directory of SBIC members. That's another good resource in order to find, maybe a locally based SBIC.
Of the approved leveraged licensees in 2012, what percentage has been approved for 2 times leverage?
It's a good question. You can either take 1 or 2 times leverage. I don't know the answer to that. The only data I had were the 27 were going to use leverage and the 3 were not. I would say the vast majority of SBICs that I know and have relationships with tend to use all the leverage, just given the very compelling rates that are being offered today. You're never, ever running at full leverage. I should maybe mention that the way at least our BDC's SBIC works is we first use our equity. So we took $25 million of equity, contributed into our SBI subsidiary, our first several deals, utilized that capital, and then once that is fully deployed, we are now drawing on our SBA facility. So we're now drawing down. So we're in the first loss position. So when things go wrong, that first $25 million of BDC Saratoga capital is at risk. In a private fund, it is much more one-to-one, where by deal basis, a third of the money will come from the fund itself, and 2/3 of it will come from the SBA. And there's all sorts of waterfalls and clawbacks and things just to always maintain that that first loss position needs to be about a third.
The SBIC stated minimum is $5 million. Have they stopped issuing licenses for people raising money less than in the teens, as in greater than $10 million?
It's a great question. I've been to a number of presentations given by SBA officials, and it's in the annual report if you want to look for it there. They have in their minds, and they're very specific when they answer this question, under $5 million, very little chance of receiving a green light and moving forward to getting your license. They don't have a hard and fast rule between 5 and 17 million, although they're quick to point out that the performance of funds that manage less than $17 million is inferior compared to those that manage more. Operating risk is one of the real things they think and look at when considering issuing a license. And if your fund is deemed not to have enough current income through management fees to support the kind of professional infrastructure you need to ensure that you're doing good deals, I think they're going to have an issue with that. So there's no hard and fast rule except that below 5 million, and then that $17 million amount, I know they think about pretty seriously.
In club deals, how does Saratoga distinguish its operational responsibilities from those of its equity co-investors?
In club deals, well, I always consider club deals where we're clubbing up and kind of living in the same part of the balance sheet on a pari passu basis. And in that situation, there is always a required lender. So take, for example, we closed a deal earlier this year where there are 3 lenders like us, all kind of different sizes and stages of their life. In that case, the firm that sourced the opportunity is what is called the required lender, meaning that they are truly the official representative that the company will interface with. And then we have our own agreement within that protects the non-required lenders, so that the required lender can't do things like, forgive principal or waive interest payments or things that would be counter, to our interests. When it comes to us working with private equity firms that invest, we know our place. We're not the owner of the business. We're an investor in the business. And because of that, you'll often see us going to board meetings, but not necessarily sitting on the board. Now, that might be something unique to Saratoga. I know a number of SBICs will take control of the board, particularly those that are doing buyouts. But in our case, we like to be as much of a value-added investor as possible with our private equity friends who, in many cases, are our clients. They bring us into deals. So, we're relying on going through the due diligence process together. It is a reasonably collaborative process. Obviously, there's negotiations like in anything where the private equity firm or the company is going to want a low cost of debt, more leverage, patient money, all those sorts of things. But at the end of the day, it's very collaborative.
What is your personal opinion on the current investment environment, i.e. the quality of assets you're looking at, deal flow? What are your expectations as the economy improves?
That's a great question. At Saratoga, we track this data very closely. It's just kind of part of the market right now. If you're not tracking how many deals you're seeing, where you're seeing deals, what the pricing looks like, you're really going to be behind the game, because it's very, very important. If I look at our deal flow from last year, we saw a really nice uptick beginning back in July all the way through November, and then a tail off in December, meaning that most deals that wanted to get closed by the end of the year were out in market, call it October, November. Last year, we saw something like 400 different investment opportunities. And in this business, you strive to do, call it 2 to 3% of the deals you see. Things over the holidays, we closed 4 transactions right at the end of the year. These are deals that came in, 3 in November, 1 actually in December. And then things get quiet around the holidays, but I'll say this week in particular, the volume has picked up again. The motivations to do a dividend recapitalization, dividend recap, to benefit from the cap gains rates where they were last year, well, that's gone away. So You're not going to see probably as many business owners this front half of the year doing as many of those types of deals. You know, the dirty little secret in private equity is that there was a tremendous amount of capital raised in 06, 07, and 08 before the financial crisis. And most of these funds, most of these private equity funds, have a 5-year investment period. So if you think a fund in 07 and 08, wow, we're at the end of our investment period. We need to start harvesting our investments if we have hopes of raising fund 2, 3, 4, whatever their next fund is. So I'm pretty bullish on the market. I'm pretty bullish on where we're playing. I think you are going to see a number of sponsor-owned businesses coming to market because they have to start posting gains if they have hopes of raising their next fund. One of the common ways that private equity firms are doing that, again, is this dividend recap concept where they may not want to sell the business today because they may have a couple more things they want to do with it, maybe make another acquisition, or they're just not seeing the multiples that they think. So why not bring on more permanent capital like mezzanine, take the dividend, return your capital to limited partners, post a gain. I think we're going to see more and more of those over the next year.
Thanks, Joe. Our next question is, on average, how many licenses are granted each year?
Well, I can go back to that slide. Last year there were 30 granted, and you know, the average, I would say low 20s, mid 20s. I don't believe, and I don't want to talk out of school, I do not believe the SBA is going to start issuing 50 licenses a year. I think 30 that's a lot of work. I think they're staffed to kind of do that. I know there's a number in process now. If you look back on this slide, I'm not certain why there was a dip from 11 to 12. You've also, in the press recently, been seeing some firms publicly that have been turned down for a license. So I'm assuming that you know, a firm gets that answer, you're not likely to go back and ask again, because I'm certain the answer will probably be the same. But you know, call it mid-20s to 30s a year.
Great. And for our final question, are there any special incentives for SBICs to invest in minority or women-owned businesses?
That's a great question. There is, and I'm going to get this fact maybe a little wrong. I believe it was last year, although the timing could be over the past couple of years. 29% of all SBIC investment went into disadvantaged businesses, and that's from both disadvantaged by ownership type, area of business, all of those factors. I know the SBA is gearing up to really promote that part of the program, and we're excited to be supportive of these types of companies. What you find today, particularly in cities that are underbanked and undercovered by the finance community, is companies are small businesses, companies with less than $5 or $10 million in EBITDA are finding real difficulty attracting capital to their great companies. So, you know, we're hoping to change that. The world is becoming much more efficient. You know, you can find people so much easier today online, or you know, through networks that people maintain. So I see that number increasing. The banks in this country are becoming more like utilities, and because of that, there's a real opportunity for investors like Saratoga to fill that gap.
Thanks, Joe. I just want to let everyone know that if your question was not answered, I will send those over to Joe and he can follow up with an answer. As we draw to the close of our presentation, I would like to thank all of you for joining us today. I hope this webinar has been an informative look into the world of SBICs and the SBAs. A big thank you to Joe for hosting this session.
Thanks, everyone. Thank you, Axial Markets.
Yeah, thank you, Joe. If you're interested in staying up to date on similar written content and events from Axial Markets, including our upcoming webinar on identifying and mitigating risk in Latin American markets, Please sign up for our alerts on our events page, found at the URL shown on your screen right now. Thanks and have a great day.